On this channel, we go beyond headlines, decode complex financial events in simple language, and help you stay financially aware and prepared. Don't just follow the news, understand it. Subscribe to Capital Explained and stay one step ahead. On the morning of March 9th, 2023, thousands of people across the tech industry woke up expecting a normal workday. Instead, within hours, a single urgent message began circulating among founders and investors. Move your money out of Silicon Valley Bank immediately. What followed was not panic in the streets, but panic on smartphones. By midday, billions of dollars were being wired out. By the end of the day, tens of billions in withdrawal requests had overwhelmed the bank. Within 48 hours, one of the largest banks in the United States had collapsed. This was not a story about fraud or secret criminal activity. It was a story about how modern banking actually works and how fragile that system can become when confidence disappears. Silicon Valley Bank was the 16th largest bank in America, with over $200 billion in assets. It had operated for decades and was deeply embedded in the technology startup ecosystem. On the surface, it appeared stable. Beneath the surface, however, a dangerous imbalance had formed. During 2020 and 2021, interest rates were near zero, venture capital funding was booming, and tech companies were raising enormous sums of money. Much of that cash was deposited at Silicon Valley Bank. The bank suddenly had far more deposits than it could lend out profitably, so it invested a large portion of those funds into long-term U.S. Treasury bonds and mortgage-backed securities, considered among the safest assets in the world. The problem was not credit risk. The bonds were safe. The problem was interest rate risk. Beginning in March 2022, the Federal Reserve aggressively raised interest rates from near zero to above 5% in an effort to fight inflation. When interest rates rise, the market value of existing bonds falls. A bond paying 1% interest becomes far less attractive when new bonds are paying 5%. As a result, the value of Silicon Valley Bank's bond portfolio dropped sharply, creating billions of dollars in unrealized losses. In normal conditions, unrealized losses are manageable. Banks can hold bonds to maturity and receive full repayment over time. But banks operate on a structure called fractional reserve banking. When you deposit money, the bank does not store it in a vault under your name. It uses most of that money to make loans or buy assets. Your deposit is a short-term liability because you can withdraw it at any time. The loans and bonds the bank buys are long-term assets. This mismatch is known as maturity transformation. As long as depositors remain calm, the system functions smoothly. But if too many depositors demand their money at once, the bank must quickly convert long-term assets into cash. If those assets have fallen in value, selling them locks in losses. That is the liquidity gap, the difference between what depositors can demand immediately and what the bank can realistically access in cash. On March 8, 2023, Silicon Valley Bank announced it had sold a large portion of its securities portfolio at a loss and was attempting to raise new capital. Markets interpreted this as a sign of weakness. Venture capital firms advised startups to withdraw funds. Within a single day, over $40 billion in withdrawal requests hit the bank. No institution built on maturity transformation can survive that speed of outflow. By March 10th, regulators stepped in and seized the bank. The seizure was carried out by the Federal Deposit Insurance Corporation, commonly known as the FDIC. Deposits up to $250,000 per account are insured in the United States. However, most of Silicon Valley Bank's clients were businesses with balances far exceeding that limit. For a brief moment, billions of dollars above the insured cap were at risk. Eventually, regulators guaranteed all deposits to prevent broader contagion, but that decision was extraordinary, not automatic, and Silicon Valley Bank was not alone. Within days, Signature Bank also failed. Weeks later, First Republic Bank collapsed after massive deposit withdrawals and was acquired in a government-brokered deal. 3 of the 4 largest bank failures in U.S. history occurred within a short span of time, all driven primarily by liquidity stress. The broader system still operates under the same structural reality. U.S. banks collectively hold trillions in deposits, but only a fraction of that total sits in cash. The rest is tied up in loans, securities, and other assets that cannot be instantly liquidated without consequences. If confidence remains intact, the system works. If confidence breaks, liquidity evaporates quickly. Deposit insurance provides an important safety net, but it has limits. The FDIC's insurance fund is small relative to total insured deposits. In a widespread crisis, it would rely on borrowing from the U.S. Treasury. While the government has strong incentives to prevent systemic collapse, there is no scenario where massive simultaneous withdrawals would be painless or immediate. The lesson is not that banks are inherently corrupt or that collapse is inevitable. The lesson is that banking is built on trust and timing. Deposits are available on demand, but the assets backing them are long-term. That gap between short-term promises and long-term investments is profitable in stable times and dangerous in volatile ones. Understanding this changes how you think about cash management. It raises important questions about diversification, deposit insurance limits, liquidity planning, and concentration risk. Because in modern finance, the greatest threat is often not insolvency in the traditional sense, but the speed at which confidence can disappear. And when confidence disappears, liquidity follows. There is another dangerous side effect of government bailouts that few people talk about. When depositors believe the government will always step in, they stop paying attention to the health of their bank. If no one monitors risk and no one pulls deposits when warning signs appear, weaknesses quietly build inside the system. Problems compound, losses grow, and instead of small failures that get corrected early, you end up with sudden, catastrophic collapses. The uncomfortable truth is that the structural weaknesses that brought down banks in 2023 have not disappeared. First, unrealized losses are still sitting on bank balance sheets. According to recent Federal Reserve data, U.S. banks collectively hold roughly $500 billion in unrealized losses on securities. These are primarily long-term treasury bonds and mortgage-backed securities purchased when interest rates were extremely low. As long as banks can hold those bonds to maturity, the losses remain on paper. But if depositors begin withdrawing funds and banks are forced to sell those securities, paper losses become real losses. Capital gets wiped out, confidence drops, the spiral begins. That is exactly what happened to Silicon Valley Bank. Second, commercial real estate exposure is a growing risk. U.S. banks hold nearly $3 trillion in commercial real estate loans, including office buildings, retail centers, apartments, and hotels. The office sector in particular is under serious pressure. Vacancy rates in major cities remain historically high. Property values in some markets have fallen 30% to 40% compared to pre-pandemic levels. Yet many loans on bank books are still valued based on older, higher property prices. As these loans mature between 2024 and 2027, borrowers will need to refinance. But if the buildings are worth far less than before, refinancing becomes difficult or impossible. Defaults rise. Banks take losses. We already saw early signs of this in 2024, when New York Community Bank reported unexpected losses tied to commercial real estate, sending its stock down sharply and forcing it to raise emergency capital. It survived, but the warning was clear. Concentrated exposure to struggling sectors can quickly threaten stability. Third, deposits have become more concentrated in the largest institutions. After the failures of Signature Bank and First Republic Bank, hundreds of billions of dollars flowed into the largest banks. Depositors assumed that institutions like JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo are simply too large to be allowed to fail. They may be right, but that concentration creates a different type of systemic risk. When a handful of banks hold an enormous share of total deposits, any shock to one of them would have massive consequences. Even strong capital ratios cannot protect against every possible black swan event, whether it is a cyber attack, derivatives exposure, or a geopolitical shock. Fourth, the speed of modern bank runs has changed the game entirely. In the 1930s, during the Great Depression, depositors physically lined up outside banks. Withdrawals were limited by geography and time. Today, billions can move in seconds. A wire transfer can be initiated from a smartphone in under a minute. When tens of thousands of people act simultaneously, liquidity evaporates before executives can respond. That is what made the collapse of Silicon Valley Bank so fast. The bank went from stable to seized in under 48 hours. So what can you actually do with this information? Start with deposit insurance awareness. The Federal Deposit Insurance Corporation insures up to $250,000 per depositor, per bank, per ownership category. If you hold more than that at one institution, the excess is uninsured. The simplest protection is diversification across banks. Split large balances into amounts below insurance limits. Yes, it requires more management, but it eliminates unnecessary risk. You can also increase insured coverage at one bank by using different account structures such as individual accounts, joint accounts, and retirement accounts. Proper structuring can extend protection significantly, but it must be done carefully and correctly. Next, monitor your bank's financial health. Most people never look at capital ratios, deposit trends, or loan concentration, yet this information is publicly available. Strong Tier 1 capital levels, diversified loan portfolios, and stable deposit growth are signs of strength. Heavy exposure to troubled sectors or rapid deposit declines are warning signals. If your bank is publicly traded, its stock performance can also offer clues. Markets often detect stress before depositors do. Consider maintaining a modest amount of physical cash for short-term emergencies. This is not about fear or extreme behavior. It is about resilience. If digital systems freeze temporarily or withdrawals are restricted, having a small cash buffer can reduce stress and provide flexibility. Diversification beyond bank deposits is also essential. Keeping 100% of your net worth in checking or savings accounts exposes you not only to bank-specific risk, but also to inflation risk. Assets such as equities, government bonds held in brokerage accounts, real estate, or precious metals are not dependent on the solvency of a single bank. Diversification does not eliminate risk, but it reduces concentration. Business owners with large operating balances should explore fully collateralized deposit programs, sometimes structured through insured cash sweep networks. These programs distribute funds across multiple institutions or back excess deposits with pledged securities, providing expanded protection beyond standard FDIC limits. It is also important to understand history. Bank runs are not new. During the early 1930s, thousands of banks failed before deposit insurance existed. The savings and loan crisis of the 1980s and early 1990s saw over 1,000 institutions collapse. In 2008, major institutions failed or were forced into emergency mergers, including Washington Mutual, which remains the largest bank failure in U.S. history. Each crisis followed a similar pattern. Asset losses led to fear. Fear led to withdrawals. Withdrawals forced asset sales, and losses accelerated. The structure of banking has always involved borrowing short and lending long. That is how credit is created and economies grow. But that same structure creates vulnerability. When confidence holds, the system functions smoothly. When confidence cracks, the liquidity gap widens instantly. This does not mean a collapse is imminent. Most banks today are well capitalized. Regulators are more vigilant than in past decades. The Federal Reserve has tools to provide emergency liquidity if stress emerges. Stability, however, is not the same as invulnerability. Unrealized losses remain large. Commercial real estate refinancing risk is approaching. Reserve requirements remain structurally low. Deposits are highly concentrated. Digital withdrawals move at unprecedented speed. These are not predictions. They are structural realities. The key lesson from 2023 is not that the banking system is doomed. The lesson is that change can happen extremely fast. What looks stable on Wednesday can be seized by regulators on Friday. In banking, perception drives behavior, and behavior drives outcomes. If enough depositors believe a bank is unsafe, their withdrawals can make it unsafe. It becomes a self-fulfilling cycle. So ask yourself a simple question. If confidence in your bank were shaken tomorrow, would you be prepared? Are your deposits structured within insurance limits? Have you diversified across institutions? Do you understand your bank's financial position? Do you have liquidity outside the system if temporary disruptions occur? Preparation does not require panic. It requires awareness and modest adjustments. Spending a short amount of time reviewing your accounts and risk exposure can provide significant peace of mind. If no crisis comes, you lose nothing. If one does, preparation could prevent serious financial disruption. The liquidity gap is not a conspiracy theory. It is the mechanical reality of fractional reserve banking. Your deposit is available on demand, but the assets backing it are long-term. That mismatch fuels economic growth, yet it also creates fragility. Confidence in banking can take decades to build and hours to lose. When trust fades, withdrawals accelerate, and even large institutions can fall quickly. The goal is not to abandon the system. The goal is to understand it well enough to navigate it intelligently, because when the next period of stress arrives, and history suggests there will always be another, you want to be positioned with knowledge, structure, and flexibility, not scrambling after the headlines appear.